The broadcast is now starting. All attendees are in listen-only mode.
Hi, good morning. This is Jim Guinan with Insurance Agency Marketing. I want to welcome you to our webinar this morning. Today we will be talking about a topic called Annuities versus CDs. I do appreciate your time this morning, and we will get started with that topic in just a moment. I do want to remind you that we are recording the webinar today. So if for some reason you have to cut out early, or you just have maybe some challenges in completing it, we will have a recording available for you later today. We also will be sending out an email to those of you especially that have not before received anything. If you have interest in our academy, you will get an email from us also. So be aware of that. And I do appreciate your interest, and hope you're having a good day so far. So with that, I want to talk a little bit about some things that are going on here at our brokerage here in Omaha, some topics that we do review from time to time. And so just wanted to talk with you a little bit about our IAMS Business Builders, a way to increase some revenue for you simply by referring other agents writing life and annuity business. So certainly we appreciate that. As you know, in your business, referrals are very important. They're the lifeblood of the insurance and investment business. So what we do here at IAMS is we will pay you a $50 check, or write a check to you for $50 when you refer the agent and that individual contracts. And then from there, as they continue to write business, you essentially get an override on that producer. So in the example here, for basically $1 million of premium, you're looking at about a $2,000 bonus. And so that's unlimited. We don't cap it. So you can refer a number of producers, and we will continue to pay you that override. And that comes from us. That doesn't come out of your pocket, or somehow out of your pocket or their pocket. So we want to say thank you for referrals. Marketing reimbursement program continues to move forward. We did have to modify the marketing reimbursement just a little bit this year. We levelized it, but still dollars being thrown into your account as you write business ongoing. It does not have a closeout date. So we don't, at the end of this year, say use it or lose it. You can continue to build it and then be reimbursed for your business expenses. As you get those expenses, send us the receipts. We'll reimburse you 50%. And again, it is a building program. You can use it for legitimate business expenses, and those would get directed into our accounting department. So again, our way of helping you as you continue to write business with us, we will help share in your business expenses. Our new producer bonus is continuing on in 2018. We've done this for a number of years. This is for your first 180 days of writing business with us at IAMS. So as you can see, when you hit, when the 180 days is up, whichever threshold you're at, these are the examples of rewards that you can look to get. And again, the one that's not showing at $500,000, the gift card or cash reward would be $3,000. So that's in addition to those other, the mailing piece and the Ritz-Carlton travel package. So again, our way of saying thank you for placing your business with us to give you a jump start as a reward. And again, you can use that for whatever you want. If it's not for something specified on here. So if it's a gift card or cash, again, you can use that how you want. Our back office support, I think, here at IAMS is very good, very good. Not only do they help us in what we do, but they're there, of course, to help you. So, for example, our contracting departments, our new business department who help scrub your apps, whether it's life or annuity, our case managers who follow up on those cases to give you an idea of what's needed, what the status is, And of course, we do have coordinators that can help you with your life and annuity quotes. So again, our job as an IMO is to take a lot of that workload off of you that you might have to do if you were, let's say you were a captive agent or working direct with an insurance company. You'd have to sit on the phone to follow up on cases. And so we try our best to process the business, make sure it's flowing through so that you can go out and do what you need to do, which is sell. Our creative department is staffed right now with a couple of individuals, 3 individuals that are very qualified, and they're helping people every day, agents like yourself, with business solutions. They're quite busy, I'm told, with helping agents design websites, with improving a website, with email marketing and branding. So if those are some areas that you'd like to know more about, or if you are but would like to improve that, please talk to Tasia, Josh, or Andrew, and tell them what you're looking to do, and they'll see what they can help you with. I know they're very busy. Again, those are just 3 key areas that we're told in the marketing department that has been keeping them very active. And so we want to help you grow your business, help you brand it, make more of a presence out there in the current marketplace. And our website continues to improve. It's www.iamsinc.com. That's IAMSINC.com. If you've not been to our website, you should check it out. We have a lot of information on there, including our webinar schedule. We have a term quote engine where you can get life insurance quotes. You can find our current rate book out there, which is a book that we have at our desk. It's updated about every week with each carrier's top products, the multi-year rates, the income rider section. There's a lot of valuable information in there that you can research and you can access any time of the day. We also have a fantastic resource library. So if you've not been out there, please check it out. There's a lot of information on fact finders, on financial calculators, and just a lot of resources in that library. So again, if you need a good fact finder, or you want to kind of have some ideas that might help you in your sales, check our website out. Again, www.iamsinc.com. Okay, so IAMS Wealth Management is a division of IAMS here that we've been in business now for about 2 years. If you have interest in learning a little bit more about this area, or are already a Series 65 and need a new home for your wealth management clients, keep us in mind for that. I'm going to launch a question right now. If you would like to get some information or have a phone call from wealth management, please respond to that question, yes or no. Again, they can give you an idea of what that business model is like, what the costs are involved. The license, of course, is the Series 65, so you would become an investment advisor rep. Or you may simply have clients. You may not want to get licensed, but you may want to have clients that are referred to IAMS Wealth Management to help you with this solution. So again, there's a number of ways that can be done. They are a growing business, growing all the time. We're taking on new advisors and assets all the time. So again, if you'd like to know a little bit more about our RIA and our solution there, please answer to that poll question that I just launched, and Charles and his team will be glad to follow up with you, reach out to you, get you any information that you need, and visit further with you. So I do appreciate your responses to that. Glad to certainly help you with that. Okay, and moving on to our Life and Annuity Academy. We have another Academy date now set. Our next Academy after this one next week, of course, will be in May, and it's May 23rd through the 25th. That will be in our brokerage office here in Omaha. Of course, our Academy is a 2-day, all expense paid training. So again, you can imagine we're looking for individuals that are writing fixed annuity or life business. It doesn't have to all be business necessarily written with us, but we do want to know that they're producers. So our goal is, of course, to bring in about 35 to 40 producers. It will be in our office, as I mentioned. This is the week before Memorial Day. I do want to make that clear. 23rd through the 25th. We are accepting registrations for that now. Those people that we invite, that is an all expense paid. So travel and stay while you're here in Omaha. Again, it's a Wednesday and Thursday overnight, and we're finished on Friday afternoon. And as you can see, some of the topics, we do update and refresh this training, so we try and keep it new and competitive. But we do cover a number of advanced topics. So if you have interest in that academy, I'd welcome you to respond. We will get you an email, as I mentioned before, an email that will come out. It will have a registration link. We will ask you questions like, how long have you been in the business? What kind of business are you writing? Are you writing fixed? Are you writing variable? Are you writing life insurance? And of course, we'd be glad to answer any questions you have. So any one of the marketing staff can help you. If you do call in, like to know more, if you have a marketer that you're working with, or if you want to call me, that's fine. I'll be glad to visit with you. But again, our next academy is next week. We filled that out. That will be in West Des Moines, but this one will be set for May, and it will be in our brokerage office in Omaha. Beyond that, we haven't had any. We don't have any dates for the one beyond that. I do appreciate your interest in the academy, certainly, and again, as with any part of this webinar today, if you have any questions at all that I'm not answering or I'm not addressing with you, please write them in, type them in. I will be glad to answer those after the webinar is over and I have a chance to reach out to you. But we are excited about our academy coming up. We have 45 agents that are invited for this next one. And we want to continue to grow our business with you. And we do appreciate your interest in that. Okay, and lastly, before I get to our topic today, I do want to mention to you to stay tuned. We will have our next marketing summit in 2019, and this will be a invite as it was for this last one. The date is tentatively set for, I believe it's July or August of 2019. Don't have a lot of particulars on it yet. We haven't announced where that will be yet, but keep track. Well, I'm sure we'll be updating you through our webinars. I'm sure you'll see something on the email. Again, this will be an educational and social event, and it is invite only. So we do look forward to that and being able to convey to you when this next one will be. Okay, so let's talk today about annuities versus certificates of deposit. Many of you probably know a lot about this information, but I do appreciate your interest in. The reason I like to have this webinar is because this time of year especially is because April is the largest month or has the most volume of certificates of deposits that come due out of all months in the year. And the reason, of course, is because of IRAs. Many people contribute to IRAs, and many people throw those IRA contributions into a certificate of deposit, which may have a 6-month, 1 year, or 18-month renewal. And so April and October are, of course, the largest CD renewal months out there. And we're right in front of April right now. That's only a few weeks away. So I thought it would be timely to talk a little bit about certificates, bank instruments, and how annuities are similar and different. Again, this is fixed only annuities I'm going to talk about, but thought it would be a good time to talk about it. I last had this webinar in December, and I will be reviewing with you some rates that have updated since that time as we go through here. So let's talk a little bit about this. Annuities and CDs are savings vehicles with better rates than just bank accounts like savings money markets. But once we kind of take a closer look here, I think you'll see that annuities do have advantages for consumers, and a lot of times it's just a lack of knowledge there. So of course the situation is of each person is needs to be taken into account, and so we can't just take a sweeping and say you shouldn't have any money in certificates of deposit, because that's not true. So let's talk about three areas to compare these. First of all would be the accumulation phase, or the accumulation topic. When we talk about CDs, generally CDs have shorter maturity periods. They can be 1 month. Of course, you can go out many years with a certificate, but oftentimes they're of a year or less duration. They are issued by banks or a credit union, some type of banking institution. And of course, the goal here is for shorter term needs. All right, so it might be for a short term purchase, maybe a down payment on a car or a home, or maybe just saving something for a purchase. It could be any number of things. That's probably the ideal instrument for accumulation in the short term. Okay, and so the rate of return on the certificate is guaranteed for its maturity period. So again, the longer the term, typically the better the rate of return. Okay, so annuities, on the other hand, are for longer term. Again, annuities are a retirement vehicle. It does not mean that they have to be held till retirement, but they are typically a retirement product. So when we talk about penalties, a lot of them coincide with what we see in IRAs. So if you take money out of an annuity prior to age 59 and a half, you will pay taxes on the growth, but you also have a 10% penalty. So they do resemble certainly a retirement vehicle. All right, annuities, of course, are not issued by banks. They're issued by life insurance companies. They are a savings vehicle issued through a life insurance company. And again, they're designed for a longer term. Again, much like annuity or CDs, excuse me, the longer you hold the product, the better the rate guarantee, or the better upside potential return that you could have in an annuity. Okay, so again, not for short term, not to be used for purchases in the short term, typically used to be purchased and held. All right, so next topic or area of comparison would be tax deferral. Interest on CDs is considered income in the year it's earned. And again, in our discussion here, we're not going to talk about IRAs if that CD is in an IRA, but just generally a non-qualified product. That interest on CDs is current income, whether that's taken out or whether it's reinvested. So it generates a tax document every year, whether it's withdrawn or not. On the other hand, annuities, the interest on an annuity or the growth that's credited is tax deferred. And so as an owner, you dictate when the taxes will be paid on an annuity, because you have the choice of whether it should be withdrawn or not. So there's a big difference there. Annuities do not generate a tax document unless there's a withdrawal in that tax year. Let's talk about accessibility a little bit here. CDs are, as I mentioned before, for certain maturity periods. They may be short, 6 months, they might be a year, they might be up to 5 years. All right. Once that CD becomes due, there is a very short window where money can be withdrawn, and then it just revolves right back in. So it's not accessible in the terms of does it have a penalty-free withdrawal. certificates, you can't go in and take money out until it comes out of maturity unless you want to break in and pay a penalty. Okay. I believe most renewal periods are usually a week, maybe 10 days. That's it. So at the end of 6 months, 1 year, 3 years, 5 years, whatever term you locked in, you only get that brief window to get money out without a penalty. Okay. Again, the penalty is oftentimes over exaggerated. With low interest rate environment, the penalty on breaking into a CD is not that significant, but it is there. When we talk about annuities, depending on the product, it will offer either an interest withdrawal feature that can be taken monthly, or it can offer up to 10% of the account value once per year. So you could go in, you could request a withdrawal of getting the monthly interest, or you could go in and get a one-time withdrawal of up to 10%. It's going to depend on the product and the length of the product, but there is access every year of some type with most fixed annuities out there. Okay, so let's do another, let's continue on. We'll talk about kind of comparisons based on some topics here. Let's talk about loss protection. All right, well, with annuities, they are backed by the insurance company that issued them, with no limitations to amount or styling. With a certificate, currently they are insured by the FDIC up to $250,000 per account per institution. All right. So they both have guarantees of some type, but of course through different institutions. All right. So generally speaking, they're both safe. Let's talk about withdrawal charges. All right. Well, as when we talk about an annuity, annuities do have a surrender schedule. Surrender schedules can be short as 3 years, and you can find them as long as 15 years. So there are, again, they say withdrawal charges, but it's more surrender charges is the term. And after a period of time, these generally reduce to nothing. Okay, so again, it's like any long-term investment vehicle. One way or another, there's a charge for exiting that annuity or exiting that contract early. When we talk about certificates of deposit, they do have withdrawal penalties. As I mentioned before, the longer the term of that certificate of deposit, the steeper the penalty can be. So it might be 6 months of interest, it might be 1 year's worth of interest, and that's going to be ongoing and continual for as long as that money is in a certificate. So each time that instrument renews and it then goes back in for a new term, those penalties are there. So really, certificates of deposit are always in surrender period, always. Okay, let's talk about access. And I did mention this prior, so we don't need to dwell on it too much. Annuities do have a free withdrawal, can be up to 10%. It might be interest only. Certificates is only in the grace period, they call it, or window period. Otherwise, there is a penalty to get out. Let's move on. Talk about effects of on Social Security benefits. With an annuity, the interest on annuities is deferred until the payment begins. As I mentioned before, the owner of the annuity has the control over when money is taken out. And so, again, there's no tax document generated from those earnings because they're revolving back in and it's tax deferred. So there is nothing in there that affects Social Security benefits. On a certificate, the interest income is counted toward taxation on Social Security benefits the year it's earned. So that could lead to higher taxes on the monthly benefits. And then taxation. Again, I mentioned this a little bit earlier. Interest on a certificate of deposit is reported and taxed in the year it's earned, whether it's withdrawn or not. Now, if that certificate of deposit is registered as or set up as an IRA, that is not true. So again, and there are a lot of deposits in banks right now that are in IRAs. So this is not necessarily always the case. But if we're talking about just a non-qualified CD, non-retirement CD, this is the case that whether they take the interest or not as an owner, it's taxed. With annuities, the income is tax deferred. Income is not reported or taxed until it's withdrawn. So again, those are the comparisons. I think this chart does a good job too of helping us when we talk about these two instruments. So let's talk about free from principal, market risk, and price fluctuations. Well, both of them are. So we don't have to worry about what the market is doing, as in the stock market, securities market. The principal is guaranteed. There is no market risk. Okay, so interest earnings free from current taxation. We touched on that before. No for CDs, yes for annuity. Interest earnings are reinvested automatically with no current taxation. Again, no with a certificate, yes with an annuity. Tax liability on Social Security income. Again, these are repetitive a little bit. No on the certificate, and interest income is not from a tax-deferred annuity is not reportable till withdrawn. Liquidity. Well, they both have some liquidity. I would say that an annuity is actually more liquid because it has penalty-free withdrawals every anniversary year. The certificate is liquid in that it may not be locked up for a long period of time, but it has a short window, grace period, every term end period. So I guess you could say it's liquid in that regard, but not as flexible as an annuity. So when we talk about flexible here, they mean premium. So often annuity can be added to, more premium can be added to once it's purchased. With a certificate, you would not be able to add to it, but you could take out additional certificates. Penalty-free withdrawals, yes with an annuity, no with a certificate. Are they free from probate? And I think this is an important topic. No, a certificate of deposit is not free from probate. An annuity is, but this needs to be added to this statement. As long as a beneficiary is named on the annuity when it's either when the app is taken or later on if it's corrected, which it can be done, as long as it's a named beneficiary. If the owner of the annuity lists their estate, then they just put it back in probate. Okay. Taxation on withdrawals. Again, no tax penalty on a certificate. 10% penalty if withdrawn prior to age 59 and a half. Again, we're talking about a retirement vehicle in many instances here, or using the annuity that way. So yes, there can be, if they're under 59 and a half, there would be a penalty. And then house secured, again, we touched on that. FDIC insured up to $250,000 with the CD. With the annuity, it is the full faith and credit of the insurance company, and by state regulations, of course, that would be your state guarantee fund. So it really has a double backing there. Annuities are a very safe retirement vehicle. Okay, so how to reduce taxes with a CD rollover. So as it says here, find the client's 1040 tax return form, and if you'd like, you can illustrate the following diagram, on paper. Okay. So here's a way to convey to your prospect or client how you can reduce taxes by repositioning money in a certificate into a tax-deferred annuity. So you've got CDs at the top. It generates that 1099, as you recall, it generates a 1099. It appears on line 8A of the tax return. every year that there's interest paid on the certificates. So how do we maybe eliminate that a little bit would be to take that certificate. I think it goes back to, we have to talk about the objectives and all. It's not just, okay, well, Mr. Client, I think you should move all your money out. Let's talk about it. What's the purpose of that certificate or certificates? How can we eliminate the taxes on that? So we move it to a tax control account, which is an annuity. And as it says, other types of accounts other than CDs. Okay, so it's not just an annuity, but certainly we're talking about a way to eliminate taxes, reduce taxes, not eliminate, reduce taxes, get a better return, have just as safe a vehicle with more access. So it's a win-win. No 1099 on this tax-deferred annuity for your client. Excuse me. Okay, moving on, I'd like to go over this, and then we will they'll wrap up a little bit. Talking about earning interest versus paying taxes and the power of triple compounding. So the power of triple compounding is the interest on your principal, the interest on your interest, and the interest on money not lost to taxes. Okay, so I think this does a good job of explaining to you just how powerful an annuity can be. In the bottom here it says assumes a 7% constant yield with a 33% tax rate. So that kind of sets you up for how they arrived at these numbers. But the first section here is just interest-bearing accounts can generate interest on your principal, but if you spend it, the principal doesn't grow. So the $10,000 deposit, you're spending the interest, you're not getting any growth. You simply have the $10,000 investment left. But on the other hand, if you reinvest it, the interest in your principal, that 10 grand would grow to 39,000. Again, this is over a long term, I realize. All right, 39,000 in 30 years. And then of course, the interest on the money not lost to taxes. So you have to factor that in, and when you do, that 10 grand becomes 76 grand. All right, so annuities have in essence a triple compounding effect, but you have rates that right now compare better than many CDs, and it's tax deferred, and you're getting the compounding. So what a great option for a position of your client, a portion, I should say, of your client's retirement money. Again, the key to this is learning about your client's needs and what the purpose of those dollars in the bank are. We don't want to recommend something that is not suitable. We don't want to recommend a long-term investment option to someone that may need that money for a purchase a year or two down the road, because we certainly don't want to invest it into a vehicle and then have the client take out more than they need to or surrender the contract early and suffer the consequences. Okay, and I think I've kind of alluded to this. The key here is a fact find. This is just one part of a fact finder called the CD Questionnaire, and many fact finds that you'll see will have a section on there asking about a client's retirement assets, their mutual funds, their life insurance, and this is a section that we found that was on a fact find just devoted to certificates. So it's asking a question about the maturity date. I think the key questions on this is the maturity date, more or less finding out about when the money becomes available. Again, this could be done early in the presentation. You can do this anytime with a client. You can always do a financial review with a client, whether it's first time you're meeting them, maybe gathering more information, maybe on an annual review. It's always good to come back. Maybe you had some information, but it was real sketchy. Now you can go back at whatever part of it it's just important, I think, to identify the maturity date so you can X date those and be aware of them, just like you will for policies that are renewing. And then also, as you go down, if the client would maybe tell you a little bit more, and I think this is, of course, very important, is what is your goal? What's the purpose of that money? And that is, was it earmarked for something? Is it to provide long-term care for you and your family, for your spouse? Is it there for an emergency? What really are we earmarking that money for? Um, and as we find with many deposits in the bank, is ask if it's an IRA, because as I mentioned in the beginning, April is a huge IRA renewal month in certificates. And why is that? Because when people go to their tax preparer or do their taxes and they know that they want to make an IRA contribution, they may not have an investment advisor, or they may just not know what to do. And so they go to their bank and they open a certificate, and it really doesn't make a lot of sense to me. So finding out what it's for, what it's earmarked for, can kind of help you to whether you want to recommend that and reposition that. So I just want to make a summary here, that this hopefully gives you some ideas to how to educate your clients on an asset that they already own, or maybe they're thinking about making a deposit and certificate instead of an annuity, and you can educate them better. So it kind of gives you the advantages of an annuity, where it would be suitable, and of course now it's up to you to recommend a product. Now I did want to share something with you. I went out this morning on bankrate.com. If you've not been there, it's a great site. It's bankrate.com. And before the webinar today, I wanted to update on and give you an idea of what rates are out there on certificates and annuities. Now, I did this webinar in December, and in December, the best 3-year CD rate I could find was 2.1%. Today it's 2.4. I just went out there an hour ago before the webinar. The best 3-year certificate of deposit I could find, again, it's an online bank. I don't even remember the name of it, but the best I could find was 2.4. The best 3-year fixed annuity today is 2.5, and I have that with several companies, 2.50. So you see, we do compare quite well. They're a lot closer than they were. In December, the best 3-year rate on annuity was 2.05, and now it's 2.5. So actually, in the last 3 months, fixed annuities eclipsed CD rates, because CD rates were better in December than annuities, and now it's flip-flopped. On a 5-year basis, my best 5-year CD I could find, December was 2.35. Today it's 2.78. So that's gone up. Best 5-year fixed annuity, December 3.1, is now 3.6. And I have that with 2 carriers. And they're approved in every state except New York, and one of them in California. So they're everywhere. You could sell that annuity anywhere. All right, and then I did write down additionally a 7-year. You don't find many 7-year CDs out on Bankrate, but I just to compare, my 7-year fixed rate right now is 3.85. So you can see that CDs are okay, but the fixed rate annuities are actually surpassing them, and now by quite a bit in some terms. So not only do we have better rates, even if the rates were the same, you've got tax deferral, you've got liquidity, and safety. So again, just some ammunition for you out there. Again, certificates have their place. All investment vehicles do, but we need to educate our clients, and so that they're not top heavy with products that aren't returning them and don't have access. especially if they're dedicated as IRAs in the bank. That really makes no sense at all to me in most cases to have an IRA using a certificate of deposit. So that's, to me, again, another easy sale. So I want to thank you for your time today. If you have any questions at all about the material we covered today, or anything else that you're working on, I'll be glad to share with you who the carriers are that I'm talking about. Again, I don't want to get too specific because I don't know what states you're writing business in, but I do know these two companies that I quoted you on the 3.6, they're in just about every state except New York. But also, one last thing. I've just been talking about fixed only rates. There are many fixed indexed annuities in the marketplace today, some as short as 5 years, many at 6, and quite a few at 7-year terms that have a fixed strategy, an annually declared rate strategy, and many of those are north of 2%. Now, that is a year-to-year rate. It's not guaranteed for the term. But if you think about it, what kind of return could we potentially offer our client over a 5, 6, 7-year period if we dedicated 25% or 50% to a fixed strategy and the rest into indexing? We could be looking at even better returns then. So that too could work for your client. And they have access to 10% full death benefit. So keep that in mind also when you're recommending a fixed annuity. I want to thank you again. Have a great day and hope to help you with some fixed annuity sales soon. Thanks so much.